Walk outside and you'll see brand new cars everywhere. But the truth is, to get that car, millions of Americans are locking themselves into predatory interest rates and long-term debt they can't escape. In 2026, more than 6.54% of Americans are behind on their car payments, a number we haven't seen since 1994. And that should concern all of us. Over 15% of new car buyers are signing loan agreements with monthly payments that make no sense relative to their income. In most cases, those payments have 4 digits. Yes, you heard that right. 4 digits. And somehow, that's becoming normal. My name is Isaiah Brown, and today I'm going to show you exactly what car you can actually afford in 2026. No ego, no flexing, just real numbers that keep you out of debt. We're going to break it down across 3 income levels: $40,000, $80,000, and $150,000 per year. Here's the problem. The average new car in the United States costs around $48,000. The average loan term is sitting at 69 months. That's almost 6 years of payments, and that's just the average. Have a lower credit score? They'll probably push you into an even longer term. And with today's interest rates, you're paying significantly more per month than buyers were paying just a few years ago. So let's talk strategy, because walking into a dealership with a plan can save you thousands of dollars and a whole lot of headaches. Rule 1, the 35% rule. The 35% rule says, the total price of the car should not exceed 35% of your gross annual income. Let's run the numbers. Earning $40,000 per year, car up to $14,000. Earning $80,000 per year, car up to $28,000. Earning $150,000 per year, car up to $52,500. Now, being completely transparent, this rule is aggressive. It's designed for people who genuinely love cars and are willing to stretch their budget for one. If you just need to get from point A to point B, you can afford to be more conservative. The smarter rule, 25%. There's a less aggressive version of this rule that uses 25% of your annual salary as the ceiling instead of 35%. My personal recommendation? Use 25%, not 35%. It doesn't mean buying the cheapest car you can find, but it keeps you comfortable without putting your financial life at risk. If you remember one thing from this video, make it this. 25% of your gross annual income is the ideal ceiling for your car purchase. Rule 2, the April 20th 10 rule. This is the most practical rule for financing a car. It has 3 parts. The 20, put 20% down. If the car costs $30,000, put at least $6,000 down. Why? Cars depreciate fast, about 20% in the first year alone. If you finance 100% of a $25,000 car and it drops to $20,000 in value, you still owe more than it's worth. That's called being underwater on your loan, and it's a terrible place to be. A solid down payment protects you from that. Pro tip, 3 to 5 year, old used cars are the sweet spot. The steepest depreciation has already happened. Let someone else take that hit. The 4, finance for no more than 4 years. Longer loan terms feel easier month to month, but they cost you. 4-year loan $2, $5.29 in interest. 6-year loan $3, $8.29 in interest. That's over $1,300 thrown away. If the only way a car fits your budget is a 6 or 7-year loan, that car is outside your budget. Don't fall for it. The 10, keep total car costs under 10% of monthly income. Your total monthly car expenses, loan payment plus insurance plus maintenance, should be less than 10% of your gross monthly income. Quick formula. Divide your annual salary by 120. $40,000 per year, $333 per month max. $80,000 per year, $666 per month max. $150,000 per year, $1,250 per month max. And just because you can spend that much doesn't mean you should. Every dollar you don't spend on a depreciating asset can go toward investments, an emergency fund, or a house down payment. Buy versus lease, and everything in between. Now that you know how much car you can actually afford, let's talk about how to get it. Because buying a car isn't just one decision. It's actually 3. Do you lease or buy? Do you pay cash or finance? And if you finance, how do you structure it? Let's take each one seriously. Leasing, who it's actually for. Leasing has a reputation, and honestly, it's earned. Most financial advisors will tell you to avoid it. But the truth is more nuanced. Leasing is a bad deal for most people and the right call for a specific few. Here's the core idea. When you lease, you're not buying the car. You're paying for the depreciation that happens during the lease term, typically 2 to 4 years, plus interest, fees, and taxes. At the end, you hand the keys back and walk away. Or you buy it out at the residual value set when you sign the contract. Leasing makes sense if you want a new car every 3 years, and you're okay with that being a permanent lifestyle cost. You drive a predictable, consistent number of miles, typically under 12,000 to 15,000 per year. You use the vehicle for business and can deduct lease payments on your taxes. You want lower monthly payments, and you genuinely understand you're getting less for that lower payment. Real advantages of leasing. Lower monthly payments. Because you're only financing depreciation, not the full car value, payments are typically 20 to 30% lower than a purchase loan on the same vehicle. Always under warranty. A standard lease term aligns almost perfectly with the manufacturer's bumper-to-bumper warranty, usually 3 years or 36,000 miles. Major mechanical issues? Covered. No resale headache. No trade-in negotiations. No private party listings. Number 7-year-old car with 140,000 miles that nobody wants to buy. Tax advantages for business use. If you're self-employed or use the car for work, lease payments may be partially or fully deductible. Talk to your CPA. This one can genuinely move the needle. Disadvantages of leasing, and they're significant. Mileage caps are brutal if you go over. Standard leases allow 10,000 to 12,000 miles per year. Exceed that? You're typically paying 15 cents to 30 cents per mile over the limit. Drive 18,000 miles a year on a 12,000-mile lease, and you're looking at $900 to $1,800 in overage fees at return, every single contract. Excess wear and tear charges. That small parking lot ding? The worn interior? Dealers inspect returned vehicles carefully. Those fees add up to hundreds of dollars fast. You build zero equity. Every payment goes toward the dealer's asset, not yours. After 3 years of payments, you own nothing. Then you lease again, buy out, or start from scratch. Early termination is expensive. Life changes, job loss, relocation, a growing family. Getting out of a lease early often costs thousands of dollars in penalties. You're locked in. Stricter insurance requirements. Lenders typically require higher minimum coverage on leased vehicles, which pushes your insurance costs up. Bottom line on leasing. For the vast majority of Americans, especially anyone focused on building long-term wealth, leasing is the most expensive way to have a car over a lifetime. You're in a permanent payment cycle with nothing to show for it at the end. But if you're a business owner, drive moderate miles, want lower monthly payments, and genuinely enjoy switching vehicles every few years, it can make sense. Just go in with your eyes wide open. Buying, cash versus financing. You've decided to buy. Great move. Now, how do you pay for it? Sounds simple. In practice, it's one of the more interesting financial decisions you'll make. Paying cash. No monthly obligation, ever. Once you hand over the money, the car is yours. No lender, no accruing interest, no payment hanging over your head. You save on total cost. A $30,000 car financed over 5 years at 7% interest means you'll pay roughly $35,600 total. Pay cash. You pay $30,000. Full stop. Negotiating power. Cash buyers can sometimes get a better price, especially at independent dealerships. You're not tied to their financing department, which is often where dealers make their real profit through rate markups. No risk of going underwater. If you paid cash for a car that's now worth less than expected, you still own a car. You don't owe anyone anything. Mental clarity. There's a real psychological benefit to having no car payment. It frees up cash flow and simplifies your monthly budget significantly. The downside of paying cash? You're removing a large sum from your savings or investments. Which brings us to the other side. Financing, when it actually makes sense. Here's where it gets interesting. Financing isn't always the losing move. It depends on your interest rate versus what your money could earn if it stayed invested. This is called opportunity cost, and it's worth understanding. Say you have $25,000 in savings. You could. Option A, pay cash. 0 interest paid. Clean and done. Option B, put $5,000 down, finance the rest at 4.9%, and keep $20,000 invested in a diversified index fund historically returning around 8 to 10% annually. Over time, that $20,000 compounds. Time period. Estimated value, at 8% average return. 5 years. $29,000. 10 years. $43,000. 20 years. $93,000. 30 years. $200,000 plus. If your investment return exceeds your loan interest rate, mathematically, financing wins. But, and this is a massive but, this only works if you actually invest the money. Not spend it. Not let it sit in a checking account earning 0.01%. Invest it. Most people don't. The money gets absorbed into daily life, and suddenly you have a car payment and no investment to show for it. Worst of both worlds. A simple rule of thumb. Loan rate below 5% plus discipline to invest the difference, consider financing. Loan rate above 6 to 7%, seriously consider paying cash. Today's rates make this very relevant. Not sure you'll invest the difference, pay cash. The guaranteed interest savings is your return. One more thing worth knowing. Credit unions typically offer lower auto loan rates than dealership financing. Before you walk into a showroom, get pre-approved through your credit union or a community bank. You'll have a benchmark rate, and you'll know immediately whether the dealer's offer is competitive or not. 3 ways to meaningfully reduce your total car cost. You've got the rules. You've thought through leasing versus buying, cash versus financing. Now let's talk about 3 moves that can save you thousands of dollars, starting today. 1. Shop your insurance aggressively. This one is chronically underrated. Auto insurance rates vary dramatically between companies for the exact same driver, the exact same car, and the exact same coverage. We're not talking small differences. We're talking $1,200 to $2,400 per year in potential savings just from comparing quotes. What to do? Get quotes from at least 3 to 5 insurers before signing any policy. Use comparison tools like the Zebra, Insurify, or Policy Genius. Ask about bundling discounts if you also have renters or homeowners insurance. Review your coverage annually. Your rate from 3 years ago may no longer be competitive. A driver who switches insurers at the right time can save $100 to $200 a month. That's $1,200 to $2,400 per year. Money that could go into a Roth IRA, your emergency fund, or your next car's down payment. 2. Buy used, specifically 2 to 4 years old. Here's a fact most buyers never fully absorb. A new car loses roughly 20% of its value in the first year. Some models drop even faster. By the time a car is 2 to 4 years old, that brutal initial depreciation has already happened. The car has stabilized in value, and you can buy it for significantly less than its original sticker price while still getting a modern, reliable vehicle. What to look for in a used car? Under 40,000 to 50,000 miles. Clean vehicle history. Check Carfax or AutoCheck. 1 previous owner if possible. Up-to-date service records. A pre-purchase inspection from an independent mechanic. Not the seller's mechanic, yours. This costs $100 to $150 and has saved buyers from purchasing vehicles with hidden issues worth thousands. Certified Pre-Owned, CPO, programs from manufacturers like Toyota, Honda, and Chevrolet offer used cars that have passed multi-point inspections and come with extended warranties, giving you much of the peace of mind of a new car at a used car price. 3. Calculate total cost of ownership, not just the sticker price. This is where a lot of buyers get burned. 2 cars can have very similar purchase prices, but wildly different real costs over 5 years when you factor in fuel costs, gas versus hybrid versus electric. Insurance premiums, sports cars and luxury vehicles cost more to insure. Maintenance and repairs, brand matters enormously here. Parts availability and labor costs. Depreciation rate, some brands hold their value far better than others. Real-world example. A BMW X5 and a Toyota 4Runner might be priced within $5,000 to $10,000 of each other on the lot. But over 5 years, the BMW's annual maintenance averages $1,000 to $1,500 plus. Parts are expensive, and it depreciates faster. The 4Runner is notoriously reliable, holds its resale value better than almost any vehicle on the market, and has lower average maintenance costs. In many scenarios, the cheaper BMW ends up costing $15,000 to $20,000 more over a 5-year ownership window once everything is accounted for. Tools to use: Edmunds True Cost to Own Calculator, Consumer Reports Reliability Ratings, and Kelley Blue Book's 5-year cost of ownership estimates. Closing: the hard truth. Here's where we stand as a country right now. The average new car costs $48,000. To buy that responsibly, using the 35% rule, you'd need to earn nearly $138,000 a year. The median household income in the United States is around $75,000. Do the math. The system is designed to hide that gap. Longer loan terms lower your monthly payment and make an unaffordable car feel manageable. Zero Down offers remove the friction of needing savings. And 6- and 7-year loans bury the total cost in the noise of monthly payments. It's not an accident. It's a business model. Your job is to see through it. Stick to the 25% rule for your purchase price. Run the April 20th 10 framework before you sign anything. Shop your insurance, buy used, and calculate the real cost, not just the number on the window sticker. Do those things, and you will be in better financial shape than the overwhelming majority of American car buyers. Your future self, the one without a $1,700 monthly car payment, will absolutely thank you. If this video made sense to you, subscribe to the channel. Every week there's a video just like this one. And share it with someone who's thinking about buying a car right now. It might just save their wallet.